Hey everyone, welcome back to your weekly market outlook. This is for the 7th of April 2025. Let's get this started very quickly in terms of what we have seen last week. I think the whole issue is pretty much about tariffs, and we did talk about the Liberation Day, and we did talk about the potential on how if the tariffs was a little bit more on the aggressive case, it could actually backfire onto the U.S. economy and it could actually weaken the U.S. dollar. And we actually did get something that's actually worse than the worst case scenario in terms of how aggressive the tariff was. And obviously, if you are looking at the market today, if you have your investments at the equity market, your portfolios is probably taking a lot of a beating right now. We are officially, I would classify this in more or less in a financial crisis at this point in time. In terms of the drops that we have seen in the global market, it is pretty much equal to the global financial crisis, and potentially we could well be positioned to be in a worse case than the COVID situation. So just a little bit of an insight into what's really going on in the global market at this point in time. All right, let's take a look at the data last week. We have the RBA interest rate decision pretty much on hold at this point in time. We got the tariff issued there, which is pretty much causing a lot of the chaos there. And it did take away the labor numbers in terms of how important the labor numbers at this point in time. It's kind of irrelevant. We did have the NFP numbers way above the consensus there, and the previous month revised down to 217,000. We did get 228,000. However, the unemployment rate picked up a little bit to 4.2%. It's still well below the limit of the FOMC's 4.5%. We also had speech from Jerome Powell commenting on the whole tariff situation as well as the unemployment numbers there. At this point in time, the FOMC is not able to continue with an expedited interest rate cut. They are willing to wait and see how things are going to be developing in terms of how tariff could actually impact inflation. The concern here is with how everything has pretty much backfired into the US economy. It will significantly slow growth there to the point right now, I believe JP Morgan and Goldman Sachs has basically said, the potential for recession has pretty much gone up to 45% at this point in time. So that's the current concern that we have in the market. So last week's numbers, it's pretty much irrelevant at this point in time. This week, we are probably going to be looking at the inflation number, and this is actually going to be really important. Before that, obviously, we have the RBA's interest rate decision. They're expecting for another rate cut, 25 basis points cut. FOMC meeting minutes is also going to be released, but at this point in time, I don't think this is actually going to have a lot of impact. Pretty much with what JP has been saying last Friday, we have a clear indication in terms of where the market is actually going to be going. All right. Inflation number here is expected to fall down, cool off a little bit here from 2.8% to 2.6% of the year on year. Core CPI expected to pick up monthly from 0.2 to 0.3. Monthly CPI expected to drop from 0.2 to 0.1%. So the scenario we have here is that we are currently looking at a potentially lower inflation number. If the inflation number picks up, which I kind of doubt at this point in time that inflation could actually pick up, because the impact on the tariff on inflation is not going to be seen until at least 3 months' time. So this one here, the consensus, I think this is pretty much on the right side. We are kind of expecting inflation to be a little bit lower at 2.6%. There is a potential for an upside surprise, but it's likely going to be limited at 3%. At this point in time. But yeah, higher inflation at this point in time could actually crash the market even more. So just keep that in mind in terms of how this is actually going to impact. Now, what I think the most important data for the past 3 months, it's always the consumer sentiment. And for the preliminary consumer sentiment that we have here, we're expecting a drop from 57 to 54. This could actually go down a lot lower. So just keep that in mind because of how things have been developing for the past 2 months here. We could potentially see the consumer sentiment closer to about the 50 mark. If it drops below 50, that would send a really negative signal into the market. So, we are potentially at the brink there. There are two potential outcomes for this one here, because we have seen the VIX spiked up significantly, and in the past 3 years, when VIX spiked up, it actually takes 6 days for the market to kind of revert from its losses. So we might see that scenario, or we might see the global financial crisis scenario, or the first trade war scenario in 2016, 2018, where VIX didn't drop down quickly enough, and it drags down the market a lot. So we are not sure yet which one is actually going to be the outcome, but those are the potential two outcomes at this point in time. All right, so let's take a look at the Aussie USD. This one here takes the brunt, pretty much being a proxy currency for China. And the impact there, you can see the drop there on Friday. That was a significant drop. It was about 3 cents drop. The Aussie USD opened the market here below 60 cents. It opened at it hit low at 59.30. So from a technical perspective, we have lost a lot of key support. If the market does pull back, we are currently looking at 61 cents as a potential limit into what kind of resistance we are looking at. That's going to be halfway down the drop from Friday, and that was the previous floor as well earlier this year. So we're kind of anticipating a potential resistance building up at around 61 cents if price managed to go all the way back up there. There is a potential for things not happening the way it is going to be. Remember, we talk about the US dollar, kind of backfiring, the US dollar getting weaker. But what we find today was something actually very unique. We have an absolute correlation in the market where every assets are currently +1 in terms of correlation, which is not a normal scenario here. We don't know whether this is actually going to be a prolonged situation, or is it going to kind of hit the reset button in the day. But at this point in time, we are keeping an eye out around 61 cents. Any break above 61 cents, and yeah, we might see a little bit of a recovery on the Aussie USD. But overall, the sell-off on Friday, that would really keep buyers on the edge at this point in time. All right, the Euro USD here, it's pretty much still okay, because if we take a look at the Euro USD, the RSI remains above 60. So overall, this one here is still pretty strong, right? And the stochastics has already crossed. We talk about this, we were talking about a potential recovery last week. We did see the recovery. We also have a sell-off on Friday, but that sell-off, it's still okay. It's still being capped by the support that we have here. Pretty much as long as price is still trading above 1.09, there's still further potentials to the upside for the Euro USD. At this point in time, we are still eyeing a return towards 1.1. And then 1.2, there is a high probability if the whole thing backfires onto the U.S. economy, and in terms of how the euro is going to retaliate, depending on how the euro retaliation is on the tariff, there is a potential. We might not get there, but the potential is there for price to actually hit all the way up to 1.150. That's where the R3 on the weekly is currently positioned. So it really depends on how quick and how bad the situation is going to be for the US economy. And basically the whole world at this point in time is waiting for two things, right? Either they come back with a retaliatory tariff like what China did on Friday, 34%, which causes the chaos in the market here, and how every other nations out there is actually going to be reacting. EU is going to be reacting to them. We just don't have the time for when they're actually going to be announcing that, but it will be this week. And also, don't forget that the 10%, blanket cover tariff from the US has already taken effect on the 5th of April. The reciprocal tariff that Trump has announced is going to take place on the 9th of April. That's going to be midweek. So I would assume the EU is actually going to announce their retaliatory tariff before the 9th of April. And if that's the case, then yeah, if it's a significant tariff back to the US economy, that would actually boost the euro. So, that's something to look out for. All right, this sterling is actually on a different scenario here. From a technical perspective, this one here is a little bit weaker. The stochastics has actually crossed back down. The RSI has actually dipped down below 60. Now, In terms of support level, the sterling has also broken the support that we have in the month of March. So this cues in for a potentially deeper correction on the sterling. We might see sterling dip down back to 1.27 at this point in time. And in terms of the tariff, at this point in time, the UK is not retaliating, and you can see the patterns here. The Australian government and the UK government is not retaliating, and the damage here is to their currency. So any country that wants to retaliate, that's actually going to boost their currency. But those countries that does not retaliate, the current correlation that we look at here right now is those countries are, going to have a weaker currency. So the pattern here is that the sterling is actually weaker on the euros. So something different here in terms of how they are currently moving, also depending on their government reaction. Now the dollar yen, this one here, if you take a look at the patterns here, this is actually below 145. We did talk last week that if the tariff was aggressive, you're going to hit 145 instantly. We actually did hit 145. We did find a little bit of a support around 145, but there's actually a lot more room to go to the downside. The RSI is currently below 40, and if it maintains a position below 40, and if we take a look at what happens here, the recovery on the dollar Japanese yen was actually capped at 60. So that means the downtrend is actually really intact. We are expecting the Japanese yen to get stronger here. In terms of safe haven flows, obviously the flows is going into the Japanese yen and the Swiss franc. So the Japanese yen is actually benefiting off that at this point in time. And in terms of room to go, I think there's still more room to go for the Japanese yen here. We are currently looking at potential for the Japanese yen to move back closer to 140. That's where the low was for last year when we had that carry trade unwinding, and this time around we are expecting the unwinding to be actually a lot more. Okay, so we are currently projecting for a potential for this one to break even 140 for the Japanese yen if everything kind of backfires onto the US economy, and if the equity market in terms of risk sentiment kind of sours and everyone's not taking it kindly and it causes a lot of panic, it would actually strengthen the Japanese yen. So there's a potential for the dollar Japanese yen to track down lower. The current resistance that we have here, we're currently looking at 148 to 150. That's going to be our major resistance for the Japanese yen here. That's up from pivot to resistance 1 on the weekly, but yeah, we are really looking for prices to move down lower towards the support 1 and support 2 on the weekly pivot here. That would be at 144 and around 142. That's the minimum movement that we're currently looking at the dollar Japanese yen. So again, we have officially entered into a bear market, so just be a little bit more cautious. There's going to be a lot of volatility here. There's going to be a lot of panic sellings, and we just started the day on Monday. I can see the global market here, especially the global equity market, is already crashing, reacting to what happened on Friday in terms of what really it was the trigger. The trigger was pretty much the Chinese retaliatory tariff at 34%. That causes the panic here that, hey, you know what, maybe not everyone wants to deal with Trump, and they're just going to hit back, and that's going to damage the US economy. So everyone's just really pricing in for that recession. And every single week that we have seen, the recession fear and in terms of the probability for that recession has gone up. 2 months ago, the potential for recession was at 30%. Right now, it is currently at 45%. So just keep that in mind. I expect a lot of volatility, so good luck with the trades, and I'll see you soon.